But in a world where bonds don't offset stocks and stocks don't offset bonds, how do you broadly, other than buying a few puts here and maybe a few calls there, how do you realistically provide diversification in a portfolio?
I wouldn't wholesale discard the 60-40 portfolio as yet, Guy. It did not work, as you say, in 2022 for sure. It hasn't worked so far this year. But what I would tell you is that I think that bear flatteners are interesting right now. I think that risk-free assets with their juicy yields, I think, are appealing at this moment, especially in the higher for longer. As you know, I've been on your show many times talking about how the Fed is unlikely to cut next year, the 100 basis points previously discounted. I think it's a good chance they don't even go 50 basis points next year. It all depends, of course, on how severe the ramifications are for the economy, and if we do go into a recession or it's a soft landing approach. So I still like 60-40 portfolio. I still think that bonds should have a place in your portfolio, and I think they're getting increasingly interesting.
Kathryn, we talked about volatility in the bond market has obviously picked up tremendously. Lori Logan from the Dallas Fed said that so far the bond market movement has been orderly, and it feels like what everyone's waiting for is a disorderly bond market to then get nervous about other stuff. What is going to be the catalyst for that as we look at some of these risks surrounding the market, geopolitical or otherwise?
It's hard to imagine really that there's a disorderly or falling apart of the U.S. Treasury market, given that it's the deepest, most liquid asset class in the world and the single place that China can put their trade surplus and their current account surplus. So I think it's going to be hard to really see a disorderly unraveling of the Treasury market, especially when you see the U.S. dollar remaining the sovereign reserve currency of the world. Until there's a substitute to either of those two, it's hard to imagine that even though we have enormous deficits and debt that's really getting out of whack, that we will see a disorderly unraveling there. We do see China buying fewer treasuries, so I think that could put upward pressure on yields in a structural way over the course of the coming years. But a disorderly unraveling, for me, is really hard to envision until we get a substitute to those two main risk-free asset classes.
Another way people have been trying to hedge risk is obviously by buying oil. Kathryn, what are the implications of higher for longer oil prices? How would you factor that in?
Yeah, I think higher for longer oil prices are a tax on the U.S. consumer, which is already seeing higher rates across the board, from consumer loans to bank loans to credit cards to mortgages. So I do think that's going to take a toll on the consumer going into next year. I have liked the staples. I've liked oil. I continue to like those. I think the defensive sectors are where we need to be positioned going into next year, especially under this perhaps potentially stagflationary environment that could manifest.
Kathryn, is it going to be energy stocks or the oil price? Because at some point, we're going to see the demand destruction potentially kick in. What do you think?
I do like, at StoneX, we are a big powerhouse in commodities, especially energy, and we do like the ETFs that you can play in the oil space. So I would be long most of the majors with regard to major oil companies. I do think that they're going to have an additional good year going into next year, especially if we have high oil prices and ramping up of production here in the United States.
Do you buy defense stocks in this world as well? We've got one major conflict ongoing. We've now got another major conflict that looks like it's beginning. We're likely to see funding for those two conflicts, at least when it comes to Congress, being rolled into one. What does that mean for defense stocks in the United States? What does it mean for defense stocks in Europe? Should I be playing those names? They've come a long way already. Do you think they've got further to go?
I do think they've come a long way already. You could add additional defense stocks to the portfolio, but I would be careful with knee-jerk reactions, Guy. I would stay loyal and stay firm with the asset allocation that one has created going into next year, under the expectation that there's a high risk of recession, which I think has been augmented by this recent tragedy in Israel, especially as pertains to how much Iran is involved, how much other countries get involved. So I think that there is a high risk with regard to high inflation and a recession going into next year.
Okay, so treasuries are kind of almost looking interesting. You're buying some puts for the S&P, right? Gold, like, where else do you want to get defensive, whereas still take advantage of any movement that we see?
Well, I think, not to sound boring, but I think cash is very attractive. Cash is similar in instruments. So short-term treasuries, I think you can even start looking at longer duration. Like I said, the flatteners look appealing. So yes, look at treasuries. Defensive stocks, gold, cash, and put options on the S&P. I would even look at put options on IWM or RUT as well. So, look for that mid-cap sort of space is what we at StoneX are recommending to our clients.